All right, we are good to go. Hey, what's up, Lee, Lorna, Mirza, Mimi? All right, guys, we'll jump in here. So futures, we are getting the little gap down here to the daily 50. So we'll talk about the game plan for today. But as far as the bigger picture, obviously, pretty good selling pressure there on Friday. So from my perspective, I think for now we're looking to short the bounces. So let me see if I got my spreadsheet. Yeah, here's a spreadsheet. I'll show you guys this. All right, so here's all the trades that we've done in July and August over in my mastery. All right. Now, these are all bullish trades. So rather doing calls and we're selling put credit spreads. But these are all bullish trades. Right? Two major reasons were one, two major reasons we're having a good run here. 20% account growth, good win rate. One, they're all really clean setups, but more importantly, think of what the S&Ps were doing July through August. July through August, path of least resistance was to the upside. So there's a window of opportunity to work, look to work that bullish playbook. And such a big part of working that bullish playbook, I think really just comes down to the basics of, are we above the 21 EMA? And then always from my perspective, do we have buy signals or sell signals on the big three indicator? So here's how I'm seeing things right now. It's kind of, you flip everything upside down. Right? So all of these were bullish trades. And again, we're doing bullish trades because looking at the structure of the market, everything was pretty primo for some upside there. But every one of these trades was also the same. Like same structure, same signals, same entry, same exit. So in terms of what the bullish trade looks like, from last week, Freeport and ExxonMobil, two pretty good examples where we're going to look to get long when we're above that 21. I think ideally with a squeeze, really as many squeezes as possible. And then, of course, the trigger for us is going to be the big three buy signal. 5-minute, 15-minute, 30-minute. So Freeport, when that all comes together, is the same exact trade as Exxon, where you're buying those calls above that 21 in your daily squeeze with your buy signals. All right, so it's interesting, or maybe not interesting, but just what kind of makes it all pretty straightforward to me is if we go through a couple of inverse charts. All right, so we look at minus SPY or minus QQQ. Inverse charts, these all start to fit my bullish criteria. Right? So the inverse chart of the S&P, the inverse chart of the QQQ, Amazon, Google, etc. The inverse charts all kind of look like all these bullish trades. Right? The inverse chart of Amazon kind of looks like, Zoom looked, Cisco, Tesla. So for the inverse charts here, above that 21, 30-minute, 15-minute, 5-minute buy signal. As long as that's the case, the only game plan I could work would be to buy the dip. Inverse chart of your Qs. And I show you this because I think a lot of us, especially newer traders, we probably have way more experience under our belt playing the market to the upside. We probably got a lot more, reps under the belt taking these bullish trades. So when it comes time to short the market, and I think now's the time, just kind of the realization you're doing the same thing in the opposite direction. So check out the inverse chart of NVIDIA. I would love to buy the dip. Daily squeeze. Histogram's positive. Right? So bullish momentum. We're above the 21. 1 hour, 30-minute, 15-minute, 5-minute bullish big three. Structure, signals all tells me path of least resistance is to the upside. So from here, you're trying to just get a dip so you can get long. So with all that being said, the real charts is just the opposite. Under the 21, 30-minute, 15-minute, 5-minute sell signal. As long as that's the case, I think we're looking to short the bounces. So for those of you that watch the YouTube videos, you remember what was last Sunday's date? The 21st, yeah. So the 21st, heading into last week, we kind of did a scorecard. Points for the Bulls and points for the Bears. Heading into last week, like the major point for the Bulls was just the fact that the market was trading above key support. So heading into last week, the S&Ps were above daily 21, weekly 21, monthly 21. And of course, with Friday's flush, it's no longer the case. So it's a pretty big break of structure there. And with the futures, this might be the first spot you look for some sort of bounce. But hopefully that makes sense. Just based on the structure and the signals, I think until something changes, we're looking to short the bounces. And I'm just saying that because if I look at the inverse chart of Google, I'm going to buy that all day long. So if you would buy the dip on the inverse chart, you would look to short the dip on the real chart. So that's a game plan. Now, in a perfect world, here's what I would like to see. And I guess we'll find out if this is how it actually unfolds. In a perfect world, if we could catch a quick bid here off that 50, because here's the thing now, like the S&Ps, we're going to gap down to about 402. 402 doesn't quite take you to the 50. There's like another $4 there. Here's why I say I think you want to wait for a bounce before you get short. Even if we are going to just go from, here right to the 50, look at the hourly chart. Yeah, so if we open up at 402, at that point we're a good $10 under the hourly 21. So again, look at the inverse chart. So if we were bullish on this hourly chart, and I think we would be, it's got 30-minute, 15-minute, 5-minute buy signal. Fires a big squeeze. So if you were bullish on that hourly chart, you'd probably wait to buy that dip. Feels a little bit extended there. So I think in terms of playing the short side, we could fall apart from here. Tough to want to get short when we're going to open at 402 and your hourly 21's up there at like 412. So it could be one of these things where even if we are going to continue to trend like back here to the upside, you got to expect that dip. And if that dip can hold support, then I think you're looking to buy your calls. So over here, if we can get that bounce, and that bounce fails to fix all the problems, I think we look to buy some puts. So all in all, looking to short the bounces. And I think what I'm looking to do here, like I'll show you a couple different things I'm looking for trades in. Well, for starters, guys, where does this idea kind of go out the window? Before we start talking about, what puts are we going to buy? How much moolah can we make? Where are we wrong? And where I would start to consider the idea of being short, maybe a little bit invalid, is if the S&Ps, the Qs, etc. get back above the daily 21 EMA and we lose all of our sell signals. Like, let me know in the chat here, do you guys understand that dynamic? We can get rid of everything on the chart. We can even get rid of the Keltner channels. We can get rid of +1, -1. Right? Just that kind of basic fundamental concept that a lot of our biggest moves going to take place off of that 21 EMA. And then that next basic fundamental understanding that at some point, we're always going to come back. Explosive move, but you always come back home. Taking those basic understandings under the 21, now the probabilities begin to suggest it all kind of looks like this, where that move away from the 21 is to the downside, and of course the bounce is back up to the 21. So for me, what really puts the nail in the coffin for the market is when we're under that 21, which already kind of leans in the favor of the bears. But then we have the big 3 indicator going bearish. So here's a couple trade ideas. Again, all on a bounce. But I think for the S&Ps, S&P or QQQ, let's get our weekly chart. Right, and remember what I said, back above the daily 21, and the indicator goes from bearish to neutral. Then I think maybe we got to be a little bit careful with the shorts. But under the 21, I think it's fair game. So what I would look to do, right, on a bounce, and if you want to day trade it, you can day trade it. For those of you in the mastery, like, we're definitely going to be looking for, our typical trade, in on Monday, out on Wednesday, Thursday. But a bit, bigger picture, I think some cheap out the money puts on the S&P and the QQQ for October monthly expiration with a stop above the weekly 21 EMA. To me, that trade makes a lot of sense here from a risk versus reward perspective. So let's just pick on the QQQ. Based on the move on Friday, so based on the big break of structure, based on the sell signals, based on the strength in the dollar, all the things that kind of point towards that might be all she wrote, as far as the rally goes. Let's just say our thought process is, as long as we're under that weekly 21 EMA, 315, we're looking for the market to come back down and test those lows. So on any bounce here, I'll look for some delta 40, delta 30 puts. There's your stop. There's your target. All right, so as far as risk reward goes, let's price a few things out. I got to keep an eye on the clock here. We're good. Let's price a few things out. So QQQ, I think we're going to go to the October monthly. 4 days after my birthday, so who knows? Maybe a birthday present. Let's go delta. All right, let me see. 290. Yeah, 290 delta 30. All right, so let me see. What would I do here? Yes, let me get this to about 5,000 of risk, and then we'll just kind of look at the numbers here. QQQ. Okay, that's good enough. We'll do 7 contracts. All right, so 5,500 of risk. Now we're looking for a bounce. So right now those puts are going for $8. For conversation's sake, let's say we could actually get these puts for $6. So now it's a little bit cheaper. All right, let me get my risk up to 5,000. Do this. Yeah, it's close enough. Okay, so we catch a little bit of a bounce. All right, we're able to buy these puts for about $6. Right? October 21st expiration, 290 put for $6. Let's look at the risk reward into. We'll go end of September. All right, end of September. So if we could get this trade for about $6, right, our exit's going to be about. It'll be like 312 to 315, and we're going to target the lows. So we'll call it 270. All right, so 315, we got to cut the trade off. So into the end of September, up here at 315. On my 5,000 of risk, I'm down about 3,500. So what's that? 60, 70% loss? Down 3,500. Now down at the lows, 270. I'm up about $13,000. So again, don't focus on the dollar figure, but in terms of risk versus reward. Actually, here's how you should think of it. So let's just say you have a $100,000 account, right? Easy math. And actually, for me, this is perfect. I'm doing about a 5% risk per trade. So let's do math based on a $100,000 account. You're going to risk 5%, close enough. We're risking 4,800. That's if the trade goes to zero. Now, what I'm saying is we should take it off above the weekly 21. So maybe we lose closer to 3.5%. In terms of percentages, if you actually catch a move down to the low, 13,000 of profit on a $100,000 account is a 13% return on that one trade. So that's one idea I'm looking for. And I might size into it a little bit more. But I think the most important thing is wait for that bounce. We might not get it this morning. Maybe we got to flush a little bit more. But I would suspect at some point this week, we get a pretty big bounce. Remember, you're going to get your biggest bounces when we're trending to the downside. So I think when you get that bounce, that trade gets a lot cheaper. And of course, the cheaper you can pick up those out-the-money puts, the better the risk versus reward. So for much of the market, that's a game plan. S&Ps, QQQ, if I was inclined to short, a name like NVIDIA, I'd have to wait for the bounce. If I was inclined to want to short Google, especially with another gap coming this morning, it's all going to be a little bit oversold. But two more names I want to show you guys here. And frankly, these aren't my typical short. But again, for now, here's the thinking. Until proven wrong, I think things broke in a big enough fashion on Friday, where now the path of least resistance moving forward, maybe all the way into the Fed meeting, is to the downside. That could change today, tomorrow. And if it changes, we'll change the game plan. But I think for now, we got a pretty good shot here. It headed on back down towards those lows. Right, so as long as that's the case, and maybe that's not your thought process, but just so you get where I'm coming from, if the S&Ps and the Qs head back down to the low, is a general statement, I'm going to assume pretty much everything heads back down towards those lows. So as far as like a cheap, I don't want to call it a lotto, but as far as where you could find some pretty nice opportunity on the short side, check out something like Snow. Now, this is nothing against Snow, the company. Frankly, I don't know too much about the company. But when I look at something like Snow, and Jace, if you're in here, something like Foot Locker, never mind the lows, they're extended in terms of the daily 21 EMA. But my thinking would be, okay, if the market itself, the S&Ps and the Qs, take out the low, I don't really think Foot Locker in names like that are going to buck the trend. I don't particularly think Snowflake is going to be the one stock to buck the entire trend of the market. So again, in terms of risk reward, if you could grab on a nice bounce here, some October out the money puts on something like Snowflake, even catching that down to the daily 21, there might be a double in there. Crap hits the fan, you catch a move back down towards your lows, that's when those out the money puts start going, 10, 15x. So for me, a lot more of the trades are going to be, okay, we're bouncing into resistance, there are sell signals. Let's kind of follow the textbook and just look for those trades. But I do think maybe put aside a little bit of risk, try to find a few things here that might be extended. You're probably going to head down with the market. So I think a Foot Locker, I think a Snowflake, those kinds of things fit the bill here. But aside from that, guys, we'll see the futures here real quick. So here's what I love about the big three. Let me let's get rid of our drawing here. So check this out. Right. Markets open up in like 15 minutes. And like every trader, I'm trying to figure out, okay, are we going to bounce? Like, are we going to roll over? We're oversold. Are we going to rally? These labels up here are like kind of like the roadmap. So a few things that I've already seen this morning. Little bit of progress under the surface. The 5-minute label went from red to yellow, bearish to neutral. So did the 15-minute chart. Like, so under the surface, like little baby signs of exhaustion. Now we got the 30-minute, the 2-hour, and the 1-hour. So what I'm going to do is I'm going to take that lowest sell signal, the 30-minute, and that's what I'm going to focus on directly at the open. Right, and it's pretty straightforward. If we can't get rid of that 30-minute sell signal, we're not going to rally. If we can cancel out that sell signal, and then taking into consideration how oversold we are on an intraday chart, then we could get a rally. Right? But to me, this is like my exhaustion tool. Outside of using the indicator to look for those trades. So like Apple's a great example. It's like, okay, Apple's extended. Do we short it? Do we short it? Do we short it? No, I don't think you short it back here because every time frame kept pumping out that green label. Right? Every time frame kept producing that buy signal. There's no signs of exhaustion. So whether you're trying to get a flush in something that's strong or you're trying to get a bounce in something that's weak, what you want to look for is just exhaustion of the momentum that took you there. So what took the S&Ps from 420 to 405 in one day? It's just like it's carnage under the surface. Whole bunch of bearish momentum. If we're going to make that reversal bounce, you got to get rid of those sell signals. Otherwise, you got a full gas tank. Right? It's basically your gas tank indicator. So what I'm seeing on the futures here, okay, for now, the 5-minute chart ran out of gas. The 15-minute chart ran out of gas because it's yellow. The 30-minute chart is still working in the favor of the bears. They can cancel that out. All right, maybe they got a shot here. Maybe, just maybe. And on the QQQ futures, same thing. So I know a lot of you have the indicator. If you have the indicator, tempting to want to look for that bounce. Don't look for that bounce if we can't cancel that out. Be really oversold. But all right, guys. First off, my bad for being a couple minutes late this morning. We had a late night chasing we were chasing a mouse around the bedroom. And I'll leave you with that. One of those nights. But I do appreciate you guys popping in here. For those of you in the options room, we'll be kicking things off for today in a couple of minutes. For those of you in the mastery, we'll be live Thursday and Friday as always. And then here in the free room, I should be back today at 1 p.m. Central. And I think we've got an hour lined up here this afternoon. So if I didn't answer your questions this morning, guys, feel free to join me back here in the free room later this afternoon. And I think with an hour, what's nice about an hour, because usually they limit me to only 30 minutes with you guys in the free room. Now that we got an hour, should be able to do a couple of trades together. But all right, y'all, best of luck. Hope you found this helpful and hope to see some of you later this afternoon. Adios. Oh, Lee, no one after me? Ooh, there we go. I'm going to go head to head with whoever's doing the close in the options room. All right, guys, I'll see you soon. Thanks for your time.